Last time we discussed about the corporate performance management techniques. There we have gone through the basic principles, 4 principles, and 5 roles of measurement. Now, in that we discuss about establishing the position, then communicating direction, influencing behavior, and stimulating action and the facilitation of learning. Now, those things we discussed, and today we will go into more details on different financial aspects. Before that, I just want to go into the balance scorecard sample example, where we can just see how we can elaborate on those things. Right. To get some idea about the things what we have discussed last time. Yes. Now in the balance scorecard, we discussed different perspectives of the corporate performance. The first perspective is the financial perspective, then the customer perspective, and internal processes perspective. And at last, you get learning and growth. Now, when you go into the sample scorecard, you will find that in the internal processes perspective, we have to discuss different types of aspects where I think you see that it's a quite comprehensive type of a thing. And you have to think in certain lines of thinking. And for example, if you get the particular sample balance scorecard here, you have main topics coming under internal processes. Business growth is one of it, and continued public support is another one. Customer service excellence and optimizing core businesses. Those are the main ideas or main factors on which the sample balance scorecard is really evaluated in the internal processes perspective. Now, I think this is very much important in an organization's operations. That is why it has given such a high level of comprehension here. And you can see the factors discussed here are very much important in the operation of a business. Now there you can see the 2 things which, there's no tangible way to see how we are doing it, but through the results only we would be in a position to evaluate in what directions we are going. Now when you say customer service excellence, so how can we see whether we are going towards customer service excellence? Even in optimization of core business, that is also a type of an intangible type of a thing where you can just see whether we are really approaching that. So we need to understand in what form we are going to gauge such type of optimization of core business or excellence in customer service. There are some articulation is necessary in order to get some indicators where we can find whether we are going towards customer excellence. Or in other words, in optimization of core business also we need to have indicators valid indicators in order to gauge the direction. So in that spirit, we have to find whether these indicators are really giving the correct picture of all these factors. Now, we can just see, I mean, when you go into the business growth, what are the objectives of business growth? Capitalization on deregulation opportunities. Now, I'm just following these things, and I just want to give you more insight toward these things. Now, just look at the concept of business growth. Now, under the business growth, this particular balanced scorecard will go through the capitalization on deregulation opportunities. I think this is basically applicable for the institutions, those being regulated, because there are several industries which would come under regulation, basically the pharmaceuticals, then banking, other financial institutions. Likewise, you have different types of institutions where the regulations are very much in force. But here, what is the real target? Capitalization on deregulation opportunities. Because even though the regulations are there, in some circumstances, there can be regulatory relaxations. So you have to capitalize on those things. That is what it means by saying capitalization on deregulation opportunities. Then optimize trading opportunities. Now, I think this is very much understood, because any business person knows how to optimize trading opportunities. So therefore, I think you all will understand what it is. And you need to see ways and means of doing this, looking at the trading opportunities and optimize those things. Then the development of innovative services. Now, all these things can be just kept as concepts, but it is not the real scene here, because you need to see how you can practically come into these concepts or practically achieve these things. Use alliances and joint ventures. So this is another thing where, I mean, if you are competent enough to deal with others in such a manner where you can have joint ventures and alliances and leverage cross-group R&D. Now, this is another part where you can make use of even some other partner in your group has done some R&D or whatever, then you will be in a position to get the real result, or you can get the use of findings of those research, even that group member is out of your group, but not out of your group, within your group, but another particular organization. So you can get that findings for your benefit. These are the types of explanations which we can give under the business growth. So then you can just look at the measurements here. Now you can just see percentage of revenue from deregulated products, services. So you can now, in this particular case, as example, now this particular organization is a power electric utility company. So therefore, so you can find out what are the types of products being deregulated, and you can see the percentage of revenue you get from the deregulated products and services. So that's one measurement, and that measurement will give you an understanding, or will give you a certain idea about how you have capitalized your deregulation opportunities. So by looking at the percentage of revenue, so in other words, you can just put it this way. Say in the year financial year number one, you have a 5% of revenue from deregulated products, and in the year number two, you got 7%. That means now you are really going forward. You are really going forward in that. So you have been able to capitalize on deregulation. That means you have a growth in that deregulated product income. Now it has now the targets are given as from 5% to 10% in 3 years. So that is a type of a target which you can get, and that target work towards the capitalization on deregulation opportunities. Now you see now how valid it is, and initiatives are also given. Telecom infrastructure development is the initiative. So that infrastructure development, since with that infrastructure development, you will get the demand for these products. Then optimized trading opportunities. Now there you have a direct thing where you have to measure the percentage trading revenue. So that percentage also you have given some targets to increase, and you need to, as an ongoing process, you have to ascertain the different risk pertaining to your trading activities. Then develop innovative services. So then your measurement device is revenue from new services. Because when you have some innovative type of services introduced, and you have to just have the services and how the revenues being generated from that services, you have to go into that, and that is revenue from new services. And they have given in absolute form in dollar terms. It has been given here. I think with that you will understand what really is going to be business growth. Then use alliances and joint ventures. NPV, product service pipeline. So that is also another measurement device here. Then when you say leverage cross-group R&D, percentage of R&D projects meet in protocol gates. So that is, when you say protocol gates means, now if you want to utilize and make use of some findings done by member of your group, another member of your group, then that is what you call now. You have to go into the protocol gates to get that real results. Now we call it a research alliance program. The alliance program means now, though you are in the same group, but you are different organizations, but those different organizations should have some alliance in the research programs. That is what you mean by research alliance program. So I think you get now a particular idea here. What is all about this business growth? Now the business growth is really materialized. So get into the correct path by doing all these things. I think that gives you some understanding about how this business growth is taken into consideration in balanced scorecard, and the types of objectives coming under business growth, and how we measure these objectives, whether being achieved to a certain extent or whatever, and that those measures are also given. Now when you say D means it's a driver rather than results. Now all other things are results here, but when you see D, the meaning is it's a driver in the sense communication, education plans executed. Now it is not a product or whatever, but all others are products or revenue type of targets. But when you say D, it is a target based on drivers. It only, we look at the driver only. Driver in the sense it is not a result really. It is a type of a work which we have to do. I think you get my point. Now say here R&D projects meet in protocol gates. So that is the driver. It is not a result or whatever. It is a particular thing to be done. Now here also, I get another example here. Under the continued public support, you have uh, 4 measurement measures, and in one measure you put it as D. So that is the driver. So that driver is communication or education plans executed. So that is not a result. That is some type of an activity which we have to do. So that is why we put it as a D, driver. Right, okay. Now I think you get some idea here. Now what we can do is, now we can take a real life organization or an organization in reality and see this type of things, whether we can get these indicators by looking at the financial statements of those organizations or their annual reports or whatever it is. So that is what we can do as an exercise. Then when you say continued public support, there also you can see what are the things given. Proactively manage relationships. So continued public support is the heading. So it's a type of a process which you should follow in your organization. Proactively manage relationships. So that means you have to, with the futuristic mindset, you need to do it. That is what you mean, proactively manage relationships. Ensure reliable services. So this is also a quality aspect, because that qualities should be maintained in your organization. Then communicate, educate customers. Now this can be done through promotional campaigns or any advertisements or some programs, TV programs or radio programs, you can do that. So these are the types of things which we can really operate or really do on account of continued public support. And this is an ongoing process, and you need to measure it, and you have to see whether you are achieving the things or achieving the types of objectives by looking at these measures. So under the continued public support, you have given 3 main areas where you have to work on. Proactively manage relationships. That is the first thing. Proactively manage relationships. So how are we going to measure that? You are going to measure it through customer satisfaction, 5-point scale. Now, this is a type of a vague type of a thing where we can gauge customer satisfaction through some survey or whatever, by giving a questionnaire or whatever. So such type of things can be done. But anyway, those things are not that objective, or we can say it is a type of vague measurement. But anyway, whatever the way we have to do it, and we can have a rough idea about customer satisfaction by looking at it with a 5-point scale. So 5-point scale means we call it, in other words, we call it a Likert scale. Yeah, you can say now in satisfaction level, we can say number 1 is not at all satisfied, number 2 fairly satisfied, number 3 satisfied, number 4 you can say highly satisfied, then the last one would be extremely satisfied or whatever. So likewise, you can put that type of scale. So that is how the customer satisfaction can be measured. But anyway, these measurements are not that objective, but anyway, we have to use such type of measurement devices to measure the customer satisfaction. So that is only one example. Then ensure reliable services. Now there you have to have a reliability index. Now the reliability means whether your services are going without interruption or something like that. Breakdowns are very much minimum or such type of a thing. That is the measurement device for ensure reliable services. So then you need to develop some indices to measure reliability. For example, if you if you have a reliability measure as a particular service, say service breakdowns, and you can put it into two categories. Now you can say service breakdowns less than, say, it has been recovered, say within 10 minutes or whatever. Other service breakdowns where it took more than 10 minutes or whatever. So such type of categorization we can do and see what is our quality level. So what is the expected quality level? So it's like this. So per week we tolerate only two service breakdowns which can be less than 10 minutes duration to revive. So such type of reliability indexes can be developed. I think you get my point, because you need to see how we are going to measure the reliability. Whether you are going to measure it through the continuity of service or accuracy of service or whatever it is. So such type of things you can decide by going through the particular service or the product. Then communicate, educate customers. There you have to have a coverage or communication, education, coverage. Communication, education, plans executed. That is the third one, last one. So I think you get a meaning for this. Then if you go into customer excellence, customer service excellence, seamless cross-group delivery. So cross-group delivery means the deliveries have to be very smoothly done intra-group, within the group. Then understand customer drivers. That means what are the types of service excellence, say, drivers, or what type of things which we need to do into just show or just perceive the customers with our good services. Then effective customer services is a vague statement, but anyway, we have to be very careful when you measure this type of things. Then if you go into optimize core businesses, optimization of asset utilization, maximum return on resource allocations, continued cost management, enterprise-wide risk management. Now all these things will be taken as optimization of core business. So there you have the measures, percentage rate of capacity attained. That means capacity, optimization, asset utilization. If you can have a very high rate of utilization. Now here we go for a target of 90% in the year 3. Then employee productivity improvement, cost reduction, cost of disruption versus plan, and time to recovery. Now this time to recovery is not a financial type of thing, but it is a driver. Now time to recovery, now you need to maintain a quality to say that you have to minimize the time to recovery. That is the driver. And in the case of L&G, learning and growth, ensure market-driven skill. So the market-driven skill means the market will decide, or market will let you know what would be the skills your employees needed. So that is what you call the strategic skills. So if you have, say, if you have a need of say 100 that type of skills, but if you have only 70 of that skills with your staff members, then that is, you can say it is only 70%. That is what you call skill coverage ratio. I think that's not a very difficult thing to think. It is like this. Now you need to identify what are the types of skills you need to be with the market, or to deal with the market demands or whatever it is. And such skill profiles you have to just evaluate. And what are the types of skills you need, and you have to tick off the available skills in the organization in relation to those skills. And the coverage means, now if you have a need of 100 skills, whereas you have only 60 skills in your organization for the time being, and there is 60% skill coverage. That is what you mean by skill coverage ratio. Now, in this particular example, you see that the competencies have been increased within your organization, and you expect to have a strategic skill coverage ratio of 85% in the third year, starting with only 65%. So you expect to have a high growth of skill profiles in your organization. That is a type of a learning target. Oh, and we call such type of organizations as learning organizations. Then you can say the other point, other measure is a driver. It's not a measure, but it is a certain driver. Driver in the sense there you have hours in strategic skills training. So that means now here what you have to do is you have to have more time allocated for strategic skills training. That is what it means. So here the strategic training, this is the utilization, or this is the hours really been assigned for strategic skill training. Only 10 hours assigned in the first year, but in the second year it is 12 hours, and the third year it is 15 hours. So that means for skill training, hours been allocated at a higher level when you go into the third year. So that is a driver, hours in strategic training. So if you can increase the hours in strategic training year by year, that means now you are really going towards a particular situation where you can learn several skills in the organizations, and you will be in a position to make use of those skills in your strategic type of activities. Then employee satisfaction rating, there are also 5-point scale, as earlier I told you. Then leadership effectiveness, it is also in a 5-point scale. Now in the 5-point scale, the 4.5 is the best, but here in the scale you have from 1 to 5. So 1 is very low, but 5 is the excellent type of thing. But here we start in with 4 and we end with 4.5. I think now you get some idea about what do you mean by this balanced scorecard. But rather, I just discussed about non-financial type of things as it is. But in the first place, it is a financial perspective. There you have to see how you are going to maximize return, how you are going to have profitable growth, how you are going to have leverage in the asset base, and managing operating cost. These are the objectives given under financial, and the measures are also given here. It is we can understand that ROC, revenue growth, asset utilization rate, and all that. So that can be really understood. Now today we will try to see how we can make use of financial analysis to deal with this balanced scorecard evaluation process, and how we are going to deal with financial perspective under that. And it is a little comprehensive, and we have to go through that presentation. Yeah, I have just extracted some presentations. So we will go through that, and we will see how we can how we can arrive at the organization's financial abilities and financial strength. And by looking at the financial statement, by analyzing the financial statements, we would be in a position to see whether the objectives are being met by looking at the measures. But all these measures cannot be taken in the generic form. We need to see, or we need to just study the organization's characteristics and its requirements. Then only we can have objectives decided. So after deciding the objectives, we have to have the measures also as per the organization need. Now, organization to organization, these needs can be different. So therefore, you have to have unique measures for each organization. So you are not going to use generic type of measures for this. Now we will try to see the presentation on financial statements or financial analysis. Now, this particular analysis will give you some details about financial statement analysis. Now, when you say basics, it gives the need for comparative analysis and tools of analysis. And there's a thing called horizontal and vertical analysis. We will see what it is when you go into the details. Now, horizontal and vertical analysis with regard to the balance sheet, this comes income statement and the retained earnings statement. These are the things we do under horizontal and vertical analysis. Then when you go into the details, you will find what is the meaning of horizontal and what is the meaning of vertical analysis. Then we go into ratio analysis. Under ratio analysis, we will analyze the liquidity of the organization, the profitability of the organization, solvency, and there would be a summary also. Then earning power and irregular items. Now, this is very much important, earning power, looking at the earning power and irregular items. Now, these irregular items are very much necessary to see the way in which the organization is managed. Because have you heard about a particular principle called management by exceptions? Management by exceptions. So that is how, now that is the one management principle where you look at the exceptions and see how you can just put the organization into a smooth pathway. And that is what you call now. That is why we need to see what are the irregular items. So we have to check the irregular items to get an idea about the exceptions. So then we will be in a position to correct those things and put the organization into correct rails. So that is what we need to do. Now, if you go into details, you can just see discontinued operations, extraordinary items. That is what you mean by exceptions or whatever. Changes in accounting principle. So this is another part we have to look at. Comprehensive income. Then quality of earnings, alternative accounting methods, pro forma income, and improper recognition. Now these things will be discussed in the presentation. Now when you analyze financial statements, you have to go through the characteristics. So these are the financial characteristics. Liquidity is a financial characteristic. Profitability is also a financial characteristic. Solvency is also the same. So then those are the characteristics we analyze. Then we sometimes have a comparison base within the company, that is intra-company, industry averages, that is within among the industries, then intercompany. Intercompany means company to company. Then tools of analysis, that is what we talked about earlier. One type of analysis is called horizontal analysis, the other one is called vertical analysis, then the ratio analysis. Now this horizontal analysis is also known as trend analysis. It's a technique for evaluating a series of financial statement data over a period of time. So this is simple. I mean, if you take one organization, there you can have different years, say 3 to 4 years, you can have, or 5 years. So within those 5 years, you can see how the types of ratios been changed. Its purpose is to determine the increase or decrease that has taken place. Horizontal analysis is commonly applied to the balance sheet, income statement, and statement of retained earnings. Right, now you can just look at this example. Now here we can apply horizontal analysis if you want. Now this is a very simple example. Now say quality department store, this is the name of the organization. Now the comparison is being done between these 2 years, 2007 and 2006. Now you have the balance sheet, assets, liabilities, equity. So this is the balance sheet. So you have current assets, plant assets, intangible assets. Then liabilities, current liabilities and long-term liabilities, stockholders' equity. Now you can see now all these things are given. Now you can see now 2007 you have in the current assets you have 1,020,000, whereas in 2006 it's only 945,000. Then it's a 75,000 increase, and that is as a percent 7.9% increase. Now how are we going to do that? So what you do is you can just see 1,020,000 minus 945, that is 75, divided by 945, that you will get 7.9%. So that is how you calculate the growth rates. And if you have a lower value in that year 2007 than in the 2006, then it would be a decrease. Then you can put it in within brackets. Now, in the case of intangible assets, you see that in the year 2006 it is 17,500, and in 2007 it has come down to 15,000, and it's a decrease of 2,500. And how are we going to measure that rate? So decline rate, it is 2,500 divided by 17,500. Now that comes to 14.3%. So, but it should be given within brackets since it is a decline. But if you take the total assets, you can see it's an increase from 1.595 to 1.835, and the difference is 240,000, and 240 divided by 1595, that comes to 15%. So that is how it goes. Now in this example, Now you can see these changes suggest that the company expanded its asset base during 2007. Here, by how much? It's a 15% growth year by year, year on year. And finance this expansion primarily by retaining income. Yes. Now it is understood. Why? You can just see the liabilities been only increased by 32, only 4%. Liabilities increased only by 4%, whereas assets been increased by 15%. And uh, equity is really increased. So that is being funded basically by the in-house or inside funds. That is what here it says, retaining income, rather than assuming additional long-term debts. Now now I am asking you another question here. Why do you say this? You have to give examples or give details or quantitative details here to confirm this comment. Now, the comment is, these changes suggest that the company expanded its asset base during 2007 and financed this expansion primarily by retaining income rather than assuming additional long-term debt. Yes. Now, why do you say it is an expansion? It is a growth in assets. That is expansion. Growth in assets. So how did they grow their assets? That is what you need to check. Current liabilities can be, you can increase current liability. That's okay. But in the long term things, we need to see whether it has been increased. Yeah. Anyway, now tell me. Now you have to give an answer for this. The question is, just justify this comment by citing information or figures from the horizontal analysis, the horizontal analysis of the balance sheet. So what you need to do is that. So you have to give to justify this answer or justify this particular comment, you have to give figures. You have to give figures extracting from this horizontal analysis. That is what you need to do. So I will give you about 5 to 10 minutes to do that. Just give 2 or 3 figures, or 2 or 3 ratios or whatever, getting from the horizontal analysis to justify this comment. I think you understand what I am saying, no? And what you need to do is you need to write. You need to write how you are going to justify these comments through the figures from this horizontal analysis. Then first of all, you need to look at the comment. The comment is, company expanded its asset base during 2007 and financed this expansion primarily by retaining income rather than assuming additional long-term debt. Right. I think you can justify this comment by giving three ratios in this horizontal analysis, but you have to be categorical on that. Say you have to say this is this and this is this and this is this. So that way, then you see to justify this comment, you can really quote these ratios. Just think of it and put it in the concise form. I like to do it. I like to do it in the very concise form and very methodical and logical way. These are simple tasks, but what I want to show you is that you need to learn these things by doing it. So we will go into more challenging type of exercises at a later stage. Yes. Noani has given a good comment, and she has quoted different types of indicators getting from the horizontal analysis. I think she did a fair type of justification. Okay. Rasika also did something. Yes, net plant assets increased by 26%, 5%, and retained earnings are 38.6% growth. So I think Rasika could have done something more, because he could have said that you have to give the connection. So why we say that the particular financing is basically done through the internal generated funds. So that is what you need to highlight here. I think Noni has highlighted that, because it is being really financed by internally generated funds. Yeah, good. I think this is the way we need to look at these things, because if you do in-depth analysis only, you will find these things. Otherwise, you can't find these things. Just looking at the things would not be enough. So I think I really like to have others' comments also. Still, two persons came up with comments. I can see about 17 persons are here. I mean, you try to do something because nothing to lose, man. So you can just try out anything, no issue. No one here is going to laugh at you. Yes, I will give another 2-3 minutes to get the others' views or others' comments. I think this is a type of learning, because you will learn how to get the information from a horizontal analysis, and then justify something, some comment or whatever. Now, I think now Noni has done a good job, but what I want to tell you is when you put these things in a logical form, it is like this. You can just say the total assets been grown at 15%, growth rate is 15%, whereas the the growth of liabilities, total liabilities, is only 4%. That means the asset growth has not been entirely financed by the liabilities. So therefore, it is what is the other source? The other source is only the internally generated funds. So therefore, this particular asset growth is substantially financed by the internally generated funds. That is how we can put it. So now I think we can just cut off unnecessary details by doing that way. Anyway, okay, I think the people who I really thank the people who tried these things, and I really like to have others also try and put in their comments here. Anyway. Right, we will go to the next slide. Now there we try to do the horizontal analysis in the income statement. Now rather than looking at the comments, we will see what has really happened by looking at the horizontal analysis. Sales increased by 12%. Sales returns and allowances decreased by 20.3%. Net sales increased by 14.2%. So likewise, you can just see what are the increases and what are the decreases. Other revenues and gains been decreased by 18.2%. Expenses also decreased by 11%. Yes. Net income has increased by 26.5%. Right. Now you can give several other comments in addition to these comments. But anyway, first of all, we will look at these comments because it is easy for you to start with this. Therefore, we will go to this one first. Overall gross profit and net income were up substantially. That is correct. Gross profit increased 17.1%. Net income 26.5%. Quality's profit trend appears favorable. So I think that comment is okay. So what I am now asking is, so now it looks like gross profit increased only by 17.1, but the net income has increased by 26.5. So can you see any reason attributed to this? Now here the gross profit increased by 17.1. So rather than 17.1% increase in the gross profit, there's a higher increase in the net income. Can you give comment on that? In other words, what I am asking is how should we comment when we understand that the gross profit increase is less than the net income increase. Or in other words, net income increase is rather very much higher than the gross profit increase. But the other way about would be the normal thing. But here some abnormal thing happened. How can you attribute any reasons for this? I think you got my question correct. What has really happened? Yes. Shall we see? Yeah. So the increases of income is higher in the lower levels of the income statement. That is why lower in the sense now in the upper level you get the gross profit and such things now. So in the lower levels you get an increase in their incomes rather than the expenses. Expenses being decreased in some cases. Yeah, right. I think your argument is correct. Okay. Right. We will go to the next one. You can see retained earnings January 1st, 2006 it is 376,500. 2007 it is 525 525,000. Net income added, deduct dividends. So you can just see the bottom part of it from 2006 525 to from 2000, by 2007 727 600. Right. Now you just see retained earnings. Uh, if you look at the January 1st level, it is a 39.4% increase. If you compare the 2 years Januaries, 2007 January 1st, it is 525,000, and in 2006 it is 376 and 500. The difference is 148,500, and the percentage increase is 39.9.4. So at the beginning, but anyway, at the end also, retained earnings been increased by 38.6, but that's a marginal decrease from the earlier year. From the earlier time, it's a marginal decrease, but anyway, the retained earnings been increased by so much. So that's a type of even it is a small reduction from the last year, it's a substantial increase in retained earnings, and that shows the strength of the organization, and it really uh, solidify their accounts by adding such amount of retained earnings. 38.6 means it's very close to 40%. That's a very good indication about the growth of the organization, and their risk appetites will go up. With that, they would be in a position to do more business and really assume higher level of risk appetite. Now, see another one. In order to have a horizontal analysis, summary finances information for rose patch companies as follows. Current assets being given, plant assets, total assets. Yeah, this is a very simple exercise. Anyway, you can do that. Right, I think you can fill up these things. Yes, it's a simple exercise. Yes, you can do the exercise here. Simple exercise. Right. I think you need to come up with figures. Current assets increased by 54,000. Yes. Anyway, plant assets increased by net amount increased by 336, and total assets increased by 390. And percentage wise, current assets increased by 30%, plant assets increased by 80%, and total assets increased by 65%. 30%, 80%, and 65%. Yes. Right now, with that results, right, you can look at the details. You can see the current assets increase by 30%. As an amount, it is 54,000. Plant 336,000, and as a percentage it is 80%. And total assets 390,000 as an amount, and as a percentage 65%. Right. Now we can go to the next slide. Now we are going to discuss about vertical analysis. And this vertical analysis, also known as common size analysis, is a technique that expresses each financial statement item as a percent of a base amount. I think when you do it, you will find what it is. On an income statement, we might say that selling expenses are 16% of net sales. Vertical analysis is commonly applied to the balance sheet and the income statement both. Now there you can see in a certain statement, what are we going to just identify as the base? Now in the balance sheet, you can identify the total assets as one base and liabilities and stockholders equity as another base, same thing. So we can take it as 100%. And when looking at the other things, you can calculate the appropriate percentages. And this is a more rigorous type of analysis than the horizontal one, because it gives some contributory sense. Now, basically, if you look at the 2007 and 2006 balance sheet of this organization, you can see, if you go into the assets, there you can see, you find 55.6% of contribution of current assets in the total assets. Whereas, sorry, if you look at 2006 percentages, you have a 59.2% contribution in current assets in the total assets in the year 2006. Whereas in the year 2007, it has been decreased to 55.6. And plant assets been increased from 39.7 to 43.6. That is how this asset increase been adjusted. If you go into liabilities, there also you can find different types of liabilities been have a different contribution in different years, the 2 years. So that's how this vertical analysis been really appreciated. Right. Now you can just look at this comment. These results reinforce the early observations that quality is choosing to finance its growth through retention of earnings rather than through issuing additional debt. So you can see, now if you go into long-term liabilities, now this long-term liability contribution has come down in the year 2007 than 2006. whereas retained earnings has been increased from 32.9 to 39.7. The growth has been financed through internally generated funds. That's what it means. Right now, we go to the income statement for the vertical analysis. Now, there net sales been taken as the base, and sales returns can be given as a percentage of that. And if you go down the line, you get net sales as the 100%, and yes. Now there, even down the net sales also, you go by the base as net sales. Now this is the intercompany comparison. Now intercompany comparison is also done through the vertical analysis. Now one company is named as Quality Department Store, and the other one is JC Penney company. JC Penney is a famous company. Now in dollar terms, it is given. Net sales being taken as 100% or the base by taking into consideration net sales as the base, the others being calculated the percentages. Cost of goods sold is 61.1% of the sales. Now, if you compare JC Penney and Quality Department Store, you will find that the net income is only 5.6% of net sales if you go into JC Penney, but Quality Department Store has a 12.6% of net sales as net income. Income from operation also 21.9% of net sales, whereas JCPenney has only 11.6% as net sales, their income from operations. But under the gross profit level, both sides are more or less similar. So you can see the quality department store has a 38.9% of gross profit on sales, and JCPenney also has 38.6. So that means both are in similar level. But you can see how when you compare the income of JCPenney with the income with quality department store, you find that JCPenney has I mean, it's a 4,208 times larger than quality's net sales amount. So, but anyway, the things are, when you say gross profit ratio, whatever, it is same. But if you go into more details down the line, you find that quality department store has a higher efficiency. Right. Now, I'm asking a question here. Now, we are now looking at the condensed income statements of two entities. One is quality department store. That's a small scale one. Whereas you have JC Penney company also. But this comparison, I don't think really a rational one, but we can learn something by looking at this. That is why I have taken it into consideration. Yes. Now I am asking a small question here. You can see the quality department store, their selling and administration expenses is only 17% of net sales. Whereas the JC Penney company's selling and distribution expenses is 27% of net sales. It is almost one third, whereas it is very much less than one sixth like in the quality department store. I think you can put forward reasons for having this type of a discrepancy here. This can be taken as a discrepancy because these percentages are a little away with each other, away from each other. So what is the reason? How can you attribute a reason for that? Yeah, this is the highly, we can't, there's a mismatch between these two. So you can just give a reason for that. What is the reason? Only 17% for quality department store and only 27% for JC Penney. Yes. I think you try to answer that question. That is a good practical question. Yes. Let me have an answer. This is a simple question. You all can answer that. You look at JC Penny, there you see 27% of net sales. Now they are selling and administrative expenses. It's 27% of the net sales. Whereas the quality department stores selling and administrative expenses is only 17% of net sales. Then what is this discrepancy? You have to just give comments on that. Yes. I think now by giving this type of comments, you can have another comment also, and you can just give some ideas about uh, the nature of two companies. JC Penney can be a high volume, uh, high scale company, higher scale company, where you can find so much of staff cost and marketing cost and all sort of cost. Because of that, JC Penney has to contribute more into that than the quality department store. It's a very small department store. Basically, their marketing cost, staff cost is lower. I think your answers are correct. Only, yeah, JC may have wide range of distribution channels. Yes, yes, and both staff cost and distribution cost may higher. Right. That's a good answer. Uh, anyway, others are also answered the question well. Anything else you can put in there? Yes, I think if you if you can just give some other reason or whatever reason, not reason, you can just give some comment, some additional comment. Anyway, I will just keep it for you. I will come back again for that. Anyway, then I will go to the next slide. Then we are trying to enter into the ratio analysis. It expresses the relationship among selected items of financial statement data. Now there's a classification here. When you do the ratio analysis, we go by these three factors. Under liquidity, we do some analysis on ratios. then profitability, then solvency. Now, all these three concepts or three features are very much important for an organization. Its existence, its growth, all these things are based on or relied on liquidity, profitability, and solvency. And it's a type of now you have to strike balance between the liquidity and profitability. Most of the organizations. Now, when you say liquidity, it measures the short-term ability of the company to pay its maturing obligations and to meet unexpected needs for cash. That is what you call liquidity. It's a very short-term type of concept. It is a quick thing. And profitability measures the income or operating success of a company for a given period of time. And solvency, it measures the ability of the company to survive over a long period of time. So we call it long-term existence of a company is really measured through solvency. But if you have only one ratio, it is not meaningful. Whereas we need to do it through a comparison. Now, comparison in the sense, it can be intra-company. Now, intra-company means we get it only in the company. So, you can remember that we did now. We did the one earlier at the beginning, and that we did only in the company. We did the company, so we call it intra-company. Intercompany means you have two companies, JCPenney and Quality Department Store. Likewise, you have two companies. Then you have to have several companies into consideration, and you can say industry. In an industry, now XYZ is the industry, and you have A, B, and C all together, and those companies are in the same industry. And what you do is you take the industry average by averaging the three companies. Then we see what are the liquidity ratios. Short-term ability of the company to pay its maturing obligations and to meet unexpected needs for cash. Then short-term traders such as bankers and suppliers are particularly interested in assessing liquidity because they are very much dependent on the organization's liquidity, because if the organization is not paying their obligations on time, then the bankers and the short-term traders would be in trouble. Ratios include the current ratio, the acid test ratio, receivables turnover, and inventory turnover. Now, these four ratios are taken as liquidity ratios. Now, as it is, if you go into current ratio, it's a simple one. So, how are you going to calculate current ratio? Current assets divided by current liabilities, you get the current ratio. It is not a percentage, you get in times like 2.96 to 1. That means current assets is 2.96 times of current liabilities. That is what it means. Now, when you say acid test, it is we have another term for that. We call it quick ratio also. Now, in the acid test ratio, what you do is you get the from current assets you deduct inventory. So, cash plus short-term investments plus receivables. Now here what we do is here you can see the stocks is not available. So stocks in the sense, inventory or whatever. Inventory is not given here. So without the inventory, you get other things. Now, if you take this thing into consideration, cash has to be taken as things, then 20 short-term investments and the receivables net. But we are not going to get prepaid expenses. It may not come into the ratio. So therefore, acid test ratio is calculated by adding up, taking into consideration only cash, short-term investments and receivables, net receivables, and it has to be divided by current liabilities. Then you get acid test ratio. And we call it the immediate liquidity, or sometimes we call it quick ratio also. Then when you go to the next one, we find receivable turnover. Now, net receivables, net credit sales. Now, that is what you call receivables turnover. Now, turnover means in a particular time period, how many times the sales been turned out. Now, when you try to get the net receivables, you need to get the initial receivables and the final receivables and add it up and then divide by 2. That will give you the average net receivables. And net credit sales is the numerator. Now, when you have this receivables turnover calculated on as a number of times, then you can see, now this is per annum. So therefore, you can see the turnover time period or collection period that we can calculate by dividing 365 to be divided by 10.2, and you get the answer as 35.78 days, more than 30 days. Now, when you try to get the inventory turnover, there you have to talk on cost of goods sold, average inventory. Right, now we talked about current ratio, acid test ratio, then receivable turnover ratio, and inventory turnover ratio. Then we go to profitability ratios. It measures the income or operating success of a company for a given period of time. Income or the lack of it affects the company's ability to obtain debt and equity financing, liquidity position, and the ability to grow. Now, these ratios include profit margin, asset turnover, return on assets, return on common stockholders' equity, earnings per share, price earnings, and payout. All are taken as profitability ratios. Net income divided by net sales is the profit margin. Net sales divided by average assets. Return on assets, net income divided by average assets. Common stockholders' equity. Earnings per share, net income divided by weighted average common shares outstanding. Price earnings ratio is the market price per share divided by earnings per share. We call it PE ratio. Cash dividends divided by net income is given as payout ratio. Now, then we go into solvency ratios. Debt to total assets times interest earned. Now, these are just ratios, and if you know the formula, you can calculate. But only issue here is you have to do analysis by looking at the figures. But these calculations, if you do, then those calculations will not, give a complete idea. But you need to do an analysis. You have to give logical type of comments on that. Income before income taxes and interest expenses, that is divided by interest expenses, times interest earned. It can be taken as interest cover ratio. I think this is a normal indicator we look into when we grant advances. Interest cover ratio. But it is also known as times interest earned ratio. debt to total asset. Those are solvency ratios. Right. Now, what we are now trying to do is you get you will go to the right. Now you get the quality department store balance sheet here under the vertical analysis. Now what you need to do is you need to calculate current ratio for the 2 years, 2006 and 2007, current ratio, then quick ratio, but here only the current ratio you need to calculate, and you calculate inventory turnover and receivable turnover ratio. Right. Up now we can just see the differences of ratios in ratio analysis. Basically, we have to get the financial features, uh, characteristics of an organization by looking at the liquidity ratios, profitability ratios, and the solvency ratios. So these three ratios, three types of ratios will give us a better understanding of an organization. And when you go into these ratios, we have to get the benchmark by looking at the company's industry or the nature of the company. And there can be industry averages available. Right. We will have a small break and start the things by 4:45. Till that time, you can calculate the current ratio, receivable turnover ratio, and average collection period of quality department store. Sorry, uh, quality department store uh, with the assumption that so you have to just calculate current ratio, receivable turnover ratio, and average collection period of quality department store with the assumption that the current assets receivables increased by 10% in the year 2007. Year 2007, right? So I will keep the uh, figures here. Is it okay to keep these things this way? Right. If you wait. Okay, we can have a break now. Anyway, I will just give another one. Forget about it, and we will start by 4:45, right? I will come to the last discussed slide, and I think I just gave you a certain exercise, but as it is, the data is not available actually. So therefore, we will go into another uh, now after our discussion of ratio analysis. So I want to just give some other remarks with regard to the ratios which we have discussed. Now, all those ratios we can get into three different features, that is liquidity, profitability, and the solvency. So, under liquidity, we have different ratios, starting with current assets, asset test ratio, and uh, is the 2018 paper. Right, now you can just look at this question number 6. Question number 6. Customer experience can be defined as the sum total of experiences that a customer perceives through his mind about an organization's product, services, and process. Discuss the methods for improving customer experience. Briefly explain the strategy suggested for gaining customer experience. So this is, but this is not directly connected to the balance scorecard and that type of thing. But in the balance scorecard, we do some measurements with regard to the uh, customer relationships and all. So therefore, I can just show you this is as a one such question where even though it is not directly related. Right. But in this particular case, what I want to tell you is in the question number 6. Now, I will show you the related areas in our sample balance scorecard under this. right? So if we go to this, now in the objectives part, you have the customer perspective. So the customer experience is really coming under this. But here, unfortunately, only one thing taken into consideration: industry leading customer loyalty, customer satisfaction rating, and all sort of things have come here. But the customer service excellence has also been discussed in the internal process. So these two things you can relate to the question, and that question can be answered by looking at these things. So that is one way of getting the answers for the question. Then we can build up the answers by looking at the customer perspective of the balance scorecard. Not only that, under the internal process also we discuss about customer service excellence and different types of processes which we have introduced in the institution to serve the customer. So that is what we can gather from that question, and I think you can understand the reality of these things and taking these examples into consideration. So now here it says product, services, and process. If we go to the next question, no, I mean, there only one question comes normally, but anyway, we will see the other question paper also. Right, now just see the section D, question number 8. There you have lead indicators versus lag indicators, balance scorecard, solvency test, corporate governance. These are the things coming under this. I think this particular question has more relevance than the earlier one. There also I can show you but this doesn't have a relevance with right. Now just you can just see this particular question, that is question number 8. Okay. Right. Now this question has a particular relevance to this what we have discussed now. Now they talk about Excellent Limited is one of the most trusted bank brands in the country who has a reputation over 200 years in proving various kitchen and home appliances to the nation with a reputed after-sale service. Their record of impressive performance has been driven by consistently high standards of customer service and business performance. Their presence is everywhere in the country with more than 240 staff to service more than 4.5 million customers. Apart from their own brands, they represent some other well-renowned brands globally. Their comprehensive income statement and the financial position for the last 2 years are as follows. Now they have given the income statement. So financial position is also given. This is a lengthy statement. Now, what it says, analyze the performance of Excellent Limited in the light of ratio analysis and interpret the performance. Now, this is a direct question, right? It's a direct question, what we have really discussed earlier in the sense, the earlier session, that is with regard to the ratio analysis. So I think the particular exercise we can do now, the particular exercise, that is, I will show you the earlier presentation also, so then you will get a good understanding about it. So now here you now first of all we will try to calculate the liquidity ratios. Now under the liquidity ratios we need to calculate current ratio, acid test ratio, receivables turnover and inventory turnover. So I think you will be able to do this by looking at the question. So shall we try to do that? So you first of all you calculate the current ratio, acid test ratio, receivables turnover and the inventory turnover. Now you need to get the paper onto the screen. I will show you the screen. Right. Sorry. Now, yes. Now this is the for the years 2016 and 2015 they have given it. Right. Now with this values, just calculate the current ratio first. For the year 2016. Yes. I think it is not that difficult to calculate the current ratio. Yes. I think the first one is not a difficult one. You can just calculate it. because you have the current assets and current liabilities. So just calculate the current ratio for the year 2016. Now, this is the required information. So you can just calculate the current ratio at the beginning. So we will calculate other ratios also. I will show you the necessary details here. I will keep it as it is. First, you calculate current ratio for the year 2016. And for the both years, you can calculate current ratio. Now, what you can do is you need to have a tabulated thing where it is easy for you to do the analysis. Now we can say ratio analysis. Liquidity. And under liquidity, you have current ratio, asset ratio, then turnover, receivable turnover, inventory turnover. So this way you can prepare. Even asset test ratio you can calculate. Yes. So I think you now you might have calculated the current ratio. Why you don't get the values? Now this question paper is 2018 question paper. Right. Now I think you can see, even though we need to do only the ratio analysis and the relevant interpretation, you will get 20 marks if you do it correctly. You can see the easiness of that, and it's a sure one. If you do the correct things, you will get the full marks. But you have to do the analysis correctly. Now you get the current assets as 20,174,373. Then it has to be divided by current liabilities, 15,401 and 353. So it is around, you get 20 million 174 373 divided by 15 million 401 353. So that comes to 1.30 or 1.31 309, and it can be taken as 1.31. That is the current ratio for 2016, because it's given in the left side, and in the right side you get 2015. So when you calculate 2015, the 2016 one is 1.31. And if you calculate the 2015, that is 17,236,297 divided by 10,783,267. That comes as, sorry, 17 million to 17,236,297 divided by 10,783,267. That is 1.598, that is 1.60. Now you can see the current ratio has gone down from 2015 to 2016. So that shows the liquidity has come down marginally, not marginally, 1.6 to 1.3. Like it's a marginal, not that marginal, but you can say it's a adverse type of thing where the liquidity has come down. Right. Now this is only one ratio. Now you can go into acid test ratio also. And in the acid test ratio, what are you going to get as assets, current assets? So we just get out of inventories. Then loans due from related parties also we can get rid. Those are non-current assets. And cash equivalents you can take. Receivables you can take. Not inventories. So you can do the calculation of acid test ratio also by looking at this. Not only the current ratio. Now this is a good exercise if you do. If anyone wants to get the details of calculation, now just see. Now this is the one which we have already calculated, current assets divided by current liabilities. Then you need to go to the other one. Cash and receivables only be taken. You cannot take inventory. You cannot take other type of assets. So if you take these items, then you can calculate the quick asset ratio or acid test ratio. That is about quick asset or acid test ratio. Then you need go to the yeah, cash plus short-term investments plus receivables. Now, by looking at this, you should really decide what type of items you should take to get into the numerator of this ratio. Then we need to go to the next one, receivables turnover ratio. First of all, you need to get credit sales, net credit sales, divided by average net receivables. Now this is a type of a ratio where you can get several information. Now in this case, in the calculation of acid test ratio, you can take this cash and cash equivalent. This is not, this we can't take as an investment. You can have to take receivables. Income tax, loans due from related parties also taken as receivables. So therefore, we can just get rid of only the inventories. Others also can be taken as only short-term things. So therefore, you can take all these things into consideration without the inventories. And it has to be divided by current liabilities. Then you get the acid test ratio. So I wonder why you have not done it yet. Yes, Malkanti and others can do this. Why you have any issues because you are not getting this information? I don't know whether you have this paper with you, or I think you can just follow the paper on the screen. Because if you do this calculation, I think you get a good practice, and you will get the competency of doing these things. And that is, if you do it now, I think you can get a good skill, and you will learn to give comments also by analyzing the ratios you have calculated. Yes, Nuani, I think your calculations correct. Now you just see, this is the figures for current ratio. In 2016 is 1.31 and 2015 is 1.59. Current ratios, have you calculated? No. Anyway, now when you go into current ratio, it is you just take out inventories. Then 21,74,373 minus 7,793,195. It has to be divided by 15,401, 353. That is yeah, 0.80. And you take the other one from 17,236,297 minus 6,677,027 divided by 10,783,267.97. Yeah, Asika answer is correct. Noni, yes, Noni correct. But 2016 it should be 0.8 something. Noni, just check it up again. Okay, okay. Now we go to the next one, that is receivable turnover. Now you can get the sales figures. Now we have to assume all these are credit sales. You need to assume that all these are credit sales. And you can just go into the receivables. Here they have not given any indication with regard to the credit sales or whatever, but you can assume that the sales been done on all on trade basis. And you can have sales divided by receivables. Trade receivables, but what they say is trade and other receivables, but you can put it as trade. So in that case, you can have 9.8 as receivables, then sales, credit sales, 39. 39, 267, 203 divide by 3.97. Anyone got it? Yeah. Receivable turnover is 3.97. Yes. One is correct. Answer is correct. 4 and 397, 3.52 and 3.57 inventory turnover. Now, if you go into a now when from getting into time the inventory turned up, so that is also another thing to be calculated. So I think that calculation, if you do, collection period and the days inventory, and so you can calculate days in inventory and the average collection period. By the receivables turnover and the inventory turnover. So what you need to do? You need to divide it by 365 divided by the turnover. then you can get the days, number of days. No, only you can calculate the number of days also. Inventory days in inventory and receivable period. So in the 2016, year 2016, it should be 365 divided by 3.97. In 2015, it is 365 divided by 4. And inventory turnover, so there you get inventory, time in inventories, days in inventory, that is 365 divided by 3.57 and 365 divided by 3.52. So you can get the number of days by looking at that. Yeah. So that means collection period is 92 days and 91 days. Inventory days in inventory would be how much? (102 days and 103 days. Now, what is the nice thing here? There's no big difference if you take the 2 years. Even in current ratios and the acid test ratios, you don't see that much of a difference, but comparatively, the difference in current ratio is higher. Difference in current ratio is higher. Right. Okay. Now we have got the numbers. So we can give a commentary on the liquidity of the organization. Right? So what type of a commentary you would like to give? I think when you calculate these things, you need to tabulate. Now the tabulation has to be done. As it is, I will put the tabulation. Inventories. 3.57 and 3.52. Receivable 3.97 and 4. Acid test ratio 0.8 and 0.97. Right. Now, the main part here is the now you see the tabulation and looking at these figures, you need to give a very valid and very compact type of comments. Now, these ratios are very much instrumental in giving a comment on the liquidity of the organization. And when you give the comments, you have to take into consideration the organization's nature. And that nature is given in the question. So you read it. That is also to be read. And after reading that, you get an understanding about the organization's nature. And take into consideration that nature, and you have to have the figures. So you need to make up a story with the given information with regard to the organization and the result you got from the figures. So I like to get your comments for this this particular organization's liquidity. These particular trading organization who deal with kitchen appliances and that type of things. I just expect from you at least 2 comments. 3 comments, if you can give 3 comments, that would be better, but at least 2 comments to be given. And it has to be very compact, because you need to give compact comments on this. Even you can add into the schedule the day's inventory and the receivable period. Yes. Now you really see the, yeah, yeah. So that's it. Now you can give the different comments. I think by looking at the given or calculated indicators. Yes, Rasika's comment is there. Stocks remain in the inventory for closer to 3 months. That is 102 to 103 days means that, yes, until they are sold. So that means now they need to keep some stocks that way, or I think that really compel them to have bank credit or whatever to maintain the working capital. But if you compare the 2 years, there's no big change. It's a very marginal type of a change which happened. But you can just see, if you look at the direct current ratio, or that those are taken as main indicators or direct indicators of liquidity. Current ratio and the quick asset ratio, or the acid test ratio. So what can you say about it? That is why you need to give one, at least 2 comments on this. But the rather, I mean, a compact comment which can be given easily has not given yet. I think that's very easy. I think rather than going to all this inventory and all that, you have very handy type of ratios to comment on the liquidity. Yeah, yeah. Sampath's comment is rather okay. Company is in a liquidity, healthy liquidity position. But if you take the current ratio also, you can find it has come down from 1.59 to 1.3. So marginal drop in liquidity is there, but still they are in a adequate level of liquidity. But if you take it as an early warning signal, then you need to see why that liquidity has come down even in a marginal manner. So that I think that comment also you can give in the more precautionary uh, perspective. I think you get what I am going to say. Now, even the liquidity position is okay, you can find that it is in the trend of declining. That declining trend really is not a very substantial, but it's a marginal type of a decline. Even though it's marginal, it might give a certain warning signal, because if you can correct it before it become a larger issue. So in other words, there's a saying that stitch in time saves nine. So therefore, that particular uh, idiom is very much applicable for this type of situations. Now you see only a very marginal drop in the liquidity, but if you you know don't have any regard for that, or if you don't take it seriously, then don't take it seriously, then it's a matter. Sometimes it might uh, get serious in time to come. So therefore, I think that type of comments are very much important in analysis of organization's performance. I think now you get my point here. So such type of things are very important, rather than telling that the liquidity has come down or liquidity has gone up or whatever it is. But if you find that the even the liquidity has come down in a marginal manner, the liquidity is in safe and comfortable positions, but you have to see why that trend has been initiated, and how are we going to correct that, or how are we going to reverse that trend. So such things to be taken into consideration by the management. Okay. Now I think with that the liquidity, the comments or the performance with regard to the liquidity, I think we have done a rather comprehensive analysis. So then we can move to the next level, that is the performance on profitability, or how the organization is really going through the profitability targets. Yes. And what are we going to calculate? If you want to get more insight into that, I will just show you again our presentation. Profit margin, asset turnover, return on assets, return on common stockholders' equity, earnings per share, price earnings ratio, and payout. All these things can be taken as profitability ratios. So for the time being, we will try to analyze profit margin, and return on assets and return on equity. I think I just want you to do profit margin first, then return on assets and return on common equity. That is with regard to the profitability. Since this is an exercise, I think better if you can go for the other ratios also, because you can get the details or information in calculating these things. Okay. Equity really, yeah, equity shares are given. Then you can calculate even earnings per share also. Right, right. Anyway, for the time being, we will go only to the profit margin, the return on assets and return on equity. Yes, I think the things are available here. If you get the total assets, then it is easy for you to do the calculation on return on assets. Yes.
So I can't see the question.
Question is anyway. Question is this: you need to calculate the
No,
ratio.
paper.
Paper. You can't see it now. It is not on the screen.
No, sir.
Oh, wait. Yes, it's not there. Sorry. Right. Is it there now? No. Right. Right. You do the calculation. The profit margin return on assets, and return on equity. Yes. So you can calculate the profit margin also. Sales and revenue. Income. You can get net income here divided by revenue. That gives you the profit margin. Just try to calculate the profit margin and the return on assets. No, you can just qualify these things, because short-term liquidity position, as you say, more or less the same, but you can say there's a particular trend initiated by, say, marginal drop is there in the quick asset ratio and the current ratio. Marginal. But that has to be highlighted. Right, now I think you can calculate the profit margin and the return on assets. I don't know whether you are not getting the numbers here. Right. I think I just want you to calculate profit margin, the return on assets, and the return on equity as per profitability ratios. So you can do that, and you can have a tabulation for that also. Then you calculate the solvency ratios as it is, and you can give very valid comments on those things, taking into consideration the information given in the question. Now, look at the question first. Excellent Limited is one of the most trusted brands in the country who has a reputation over 200 years in proving various kitchen and home appliances to the nation with a reputed after-sales service. Their record of impressive performance has been driven by consistently high standards of customer service and business performance. Their presence is everywhere in the country with more than 240 staff to service more than 4.5 million customers. Now, it seems that the organization has a rather, big customer base. Apart from their own brands, they represent some other well-renowned brands globally. Their comprehensive income statement and the financial position for the last 2 years are as follows. Now here what are we going to do is, now we try to see how we analyze their financial perspective. If you take in terms of balance scorecard, we have not done anything with regard to the customer, with regard to the internal processes, or with regard to the learning and growth or whatever. So we can comment on that also if you want to put it in perspective, and you can show that you know how to do a performance analysis and how you can analyze the things with the help of a balance scorecard. So such things are necessary in answering this question. So you can make use of all the details here. You can give appropriate comments. Because you see, even though the lengthy information is available, the question is a very one sentence question. Analyze the performance of Excellent Limited in the light of ratio analysis and interpret the performance. When you say interpret the performance in the light of ratio analysis, that's what they have given. So therefore, it doesn't imply an analysis of balance scorecard. It doesn't imply. However, you can mention about it, saying that the ratio analysis only goes through the financial perspective. And you have to say that for an organization to be, analyzed on the performance basis, it is not really adequate to only analyze the financial aspects. So there are other aspects also to be analyzed. So when interpreting the performance also, you have to go by that. So that is, your answer would be very much complete if you put that in also. Right, anything to be clarified now? So I think as homework, you can complete this, and you can really forward the things to me, and I will be in a position to go through it and give some comments on that. And this is a very good question for you to practice, and even you can have your balance scorecard and do the comparisons with some hypothetical situations. So that's what you need to do. I think that would really help you to understand all these corporate performance management. Is anything to be clarified? If you want anything to be clarified now.
Sir, can we have the papers?
Yes, I think I will ask Menaka to send it to your emails. There are 2 papers here. So I will ask them to do it.
Okay, sir.
Right. And then what I want to tell you is you just, because there's another lesson remaining, and in that lesson I will talk in terms of return on required rate of return on capital and that sort of things in case of a bank. So we will do that in the next session. And in that session, I will try to do 1 or more questions also. Right. Anyway, you can come up with your feedbacks, and if you have any questions or any issues to be clarified, you can do that. And be prepared with all these things at the next session, right? Then thank you very much for your live participation. Thank you.